Ladies and gentlemen, welcome to the Quarter 3 and 9 months FY26 earnings conference call of Lumax Industries Limited. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on the date of this call. These statements do not guarantee the future performance of the company, and it may involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Deepak Jain, Chairman and Managing Director of Lumax Industries Limited. Thank you, and over to you, sir.
Thank you very much. Good morning, and thank you for joining us for the Lumax Industries Limited Q3 and 9-month FY26 earnings conference call. I'm joined by our leadership team, including Mr. Anmol Jain, the Joint Managing Director, Mr. Sanjay Mehta, Group CFO, Mr. Ravi Telpia, the CFO of the company, Mr. Naval Khanna, the Corporate Head of Taxation, Ms. Priyanka Sharma, Head of Corporate Communication. I would also like to introduce Ms. Surabhi Chandna, who is joined on this call as the Group Head of Investor Relations and Value Creation, and along with our Investor Relations Advisor, SGA. The result and investor presentations have already been submitted to the stock exchanges and are available on the company's website, and we trust that you've had the opportunity to review them. I will begin by giving an overview of the economy, followed by the automotive industry performance and the company updates. India's economic momentum remains strong and supported by resilient domestic demand and steady structural reforms. The economy continues to grow at a pace that places India among the fastest-growing major economies globally. The recent Union Budget reinforces this momentum with a clear focus on growth, stability, and long-term competitiveness. At the same time, the sustained push on public capital expenditure, particularly across infrastructure, manufacturing, and logistics, is expected to strengthen supply chains, enhance private investment, and generate employment. Together, these levers of consumption, support, and public capex are expected to drive economic growth. In parallel, recent developments on the trade front, including the US trade agreement and progress on the EU FTA, should be positive for the industry over the medium term by improving market access and competitiveness. Now, regarding the automotive sector, the momentum remains really strong, with the industry continuing to fire on all cylinders. The Union Budget has reinforced this outlook through a higher allocation under the PLI Auto Scheme for FY27. In addition, a 40,000 crore outlay for the electronic manufacturing program is set to enhance domestic capabilities in semiconductors, sensors, and power electronics that are critical for modern and electric vehicles. On the quarterly industry performance, despite Q3 being a seasonally weak period, the automotive industry has delivered its best-ever third quarter. As per SIAM production data for October to December quarter, the passenger vehicle production stood at about 14 lakh units, up 19% year-on-year. Two-wheelers were around 68.1 lakh units, up 15% year-on-year. Three-wheelers are roughly at about 3.5 lakh units, up about 35% year-on-year, and commercial vehicles are close to 2.9 lakh units, up 18% year-on-year. This broad-based growth has been driven by three key factors: improved affordability following the GST rate reductions, benefits from personal income tax relief enhancing disposable income, and successive repo rate cuts by the RBI, which have eased financing costs and supported demand across vehicle categories. Overall, this robust performance in H2 has led to 2025 being the best year for the Indian automotive industry across segments. The year-end sales push, healthy pipeline of bookings, and the full transmission of 2025 rate cuts into lending rates are expected to support demand, pointing to continued growth momentum into 2026-27. Regarding the Lumax Industries, we are proudly reporting our best quarterly performance in the history of our operations. Revenues for the quarter grew by 18.7% year-on-year to rupees 1,053 crores, with improvement on profitability front with EBITDA of 10.6% for Q3 FY26 compared to 8% in the same period last year. The Indian automotive lighting industry today stands at the cusp of significant technological transformation, and as vehicles become smarter, safer, and more design-led, lighting has evolved from a functional component to a key element of safety, differentiation, and brand identity. With the rapid shift of LED technology, advanced lighting systems, DRLs, and signature designs, the content per vehicle continues to rise. This structural premiumization presents a strong value opportunity, and Lumax Industries is well positioned to benefit from the increasing technology intensity per vehicle. Over the years, we have evolved alongside the industry and in many ways led its advancements. Through a long-standing partnership with Stanley, a global leader in automotive lighting, we have introduced cutting-edge technologies to the Indian market, elevating design, engineering, and quality standards. This has strengthened our product portfolio and enhanced our kit value across platforms. On the order book front, current order book stands at 1,759 crores. We have secured multiple new orders from leading OEM across segments, further strengthening our order book. In the passenger vehicle segment, we have won orders from Tata Motors for the newly launched Sierra, where we will be supplying the front fog lamps and auxiliary tail lamps. We have also secured business for the Tata Punch facelift, supplying the front DRLs and the position lamps. Our team executed the Punch lighting project at exceptional speed, transforming the concept into a delivered product in the shortest possible timeline. In the three-wheeler segment, we have also received orders from Mahindra for their last-mile mobility e-rickshaws, where we'll be supplying headlamps, tail lamps, and reflectors. In the two-wheeler segment, we have won a prestigious order from TVS for the flagship Apache RTX 300 for the supply of headlamps. On the capex front, our Bangalore plant expansion to support Maruti and Toyota's upcoming models is progressing as planned and is expected to be commissioned from Q4 FY27. Additionally, Phase 2 of our Chakan facility remains on schedule to commence operations from Q4 FY26 and will primarily cater to the requirements of Skoda and Volkswagen, further strengthening our presence with global OEM partners. Overall, supported by strong industry tailwinds and backed by our proven capabilities, deep OEM partnerships, and technology focus, we are well positioned to strengthen our leadership position. We remain confident of staying at the forefront of automotive lighting industry while driving sustainable growth and long-term value creation. I now hand over the call to our CFO, for Mr. Ravi Tetia, for updates on operational and financial performance. Please go ahead, Ravi.
Thank you, sir. Good morning, everyone. I'll walk you through the key operational and financial highlights for the quarter and 9 months ended 31st December 2025. As our CMD mentioned earlier, we have delivered our best performance to date across all key parameters. Starting with the quarter ended 31st December 2025, our total operating revenue stood at 1053 crores, reflecting a strong year-on-year growth of 18.7%. This was largely driven by robust growth in our manufacturing business, where revenues grew 35.8% year-on-year to 1014 crores. EBITDA, excluding exceptional items for the quarter, came in at rupees 112 crore, a growth of 57.3% YOY. Our EBITDA margin improved to 10.6%. The margin expansion was supported by operating leverage, improved performance across plants, and content per vehicle. Profit after tax, including share of associates, stood at rupees 47 crores, up 39% year-on-year, with a PAT margin of 4.4%. I would like to highlight that this is after accounting for a one-time impact of 15.9 crores related to the implementation of new labor codes. Now looking at the performance for the 9 months of FY26, total operating revenue stood at rupees 2984 crores, reflecting a healthy growth of 20.5% year-on-year. EBITDA was rupees 287 crores, up 41.2%, with a margin at 9.6%, demonstrating consistent improvement in profitability. PAT for the 9-month period stood at rupees 118 crores, a growth of 23%, with a margin of 4%. Once again, this includes the one-time labor code impact of 15.9 crores. Overall, the number reflects strong execution, improving operating efficiency, and sustained momentum across our business. Let me now move to our operational performance. With a continued rise in LED penetration across the automotive industry, our revenue mix clearly reflects this structural shift. LED lighting contributes over 61% of our revenue compared to 52% in the same quarter last year. We expect this share to increase further going ahead as nearly 81% of our current order book is LED based, giving us strong alignment with future market demand and good revenue visibility. For the 9-month period, the passenger vehicle segment continues to anchor our portfolio, driven by higher complexity and increased content per vehicle. PV contributed 65% of revenues, while two-wheeler accounted for 29%, and the balance 6% came from other segments. The order book mirrors this mix, with nearly two-thirds coming from PV lighting and most of the remainder coming from two-wheeler segment. From a product standpoint, front lighting, given its higher technological intensity and safety relevance, contributed around 69% of revenue. Rear lighting accounted for 22%, reflecting the growing importance of styling and design differentiation, with the balance coming from other lighting products. Coming to capital expenditure, as mentioned earlier, overall CapEx plans are progressing well. CapEx for the full year FY26 will be 350 to 400 crores, up from the earlier guided number of 220 to 260 crores in our previous call. However, this is largely due to advancement of CapEx driven by customer project timelines and related long lead time of machines and equipment, particularly for our Bengaluru new plant, wherein we are expediting execution. Overall, the 2-year outlook FY26 and FY27 on CapEx remains broadly unchanged. We continue to repay our long-term loans with improved margins and extended credit. Our net debt to EBITDA is expected to continue to reduce. With this, we would like to open the floor for questions. Thank you.
Thank you very much, sir. Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask questions may press star and 1 on their touchtone phone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. You may please press star and 1 to ask questions. The first question is from the line of Vijay Pandey from Nuvama. Please go ahead.
Hi, sir. Thank you for taking my question and congratulations for an excellent quarter, excellent set of numbers. I have a couple of questions. First, on the margin expansion. So, our EBITDA margin increased by 260 basis points, more than 250 basis points year on year. So, just want to understand how much sustainable is this level of EBITDA margin, and also should we expect further increase from here, because some of our peers have an EBITDA margin of around 12%, 13%. So can we go to that level, or is 10%, 11% is going to be the long-term perspective? So if you can just help me understand both the short-term, mid-term outlook as well as a long-term outlook on the margin front.
Sure. So this is Anmol Jain. I'll take that question. So number one, I think you're absolutely right. Quarter 3 has been a significantly higher margin, but part of that is aided by an exceptional tooling profitability as well. If you take out the tooling profitability, still we have inched forward in terms of EBITDA margins on a consecutive quarter 2 to quarter 3 basis. Tooling, as you know, is very, very cyclical. It depends on the new product launches, but we are very confident that we will continue to progressively increase our EBITDA margins. We've safely probably secured in the double-digit EBITDA margins now. We do expect for the full year also to perhaps have a similar EBITDA deliverable in terms of double-digit margin. And coming to your question on 12-13%, I think, yes, going forward, that is our endeavor. but perhaps in the next 2 years or so, we should be able to get, close to those margin levels as well. But we are pretty confident that we'll get there.
Okay, sir. Thank you. Secondly, sir, I wanted to understand how is the industry outlook looking in terms of lighting. Because we understand that LED penetration has been increasing, especially in the two-wheeler side. But if you can highlight a little bit about what is happening on the passenger vehicle side, and what will be the growth drivers going forward in the mid-term to long-run scenario?
So on the industry side, again, I think there is, as you know, the production numbers across segments have seen a very encouraging upward trend in Q3. Coming specifically for the lighting, I think the passenger vehicle continues to be one of the key factor where, almost 65% of the total lighting for us is, the market size is on passenger exterior lighting. Again, because it has a very high significant contribution per vehicle, we remain focused on expanding our wallet share across key customers. Our order book, which is at about 1,760 crores, is again a testimony of the same. We've had some significant wins. Maruti Suzuki is almost 1/3 of our order book. So again, we are expanding our wallet share, both in front lighting as well as in rear lighting, as long as the passenger vehicle is concerned. And we continue to again progress on the two-wheeler aspect as well. We are enjoying the leadership wallet share in certain OEMs like HMSI as well as Hero MotoCorp. And I think the endeavor is to grow certain key accounts where the company has recently entered, like TVS.
Okay. Very helpful, sir. Lastly, sir, if you can help us, are you also planning to get into the ambient lighting in the passenger vehicle segment? And do you plan to get into the commercial vehicle space also? Because that is going to be an upcycle. So are you planning to get in the commercial vehicle space?
So commercial vehicle is a small part of the pie today. It's about 6% of our total revenue. But again, we do see certain technological evolution, technological changes in the commercial vehicle space. And again, we are continuously engaged with certain OEMs. So we do expect the commercial vehicle piece of the pie to also expand, but it will definitely be always overshadowed by the growth we see in something like a passenger car and maybe the two-wheeler, just because of sheer volumes and the value per vehicle. So that's on the CV part. In terms of ambient lighting, while the company does have one specific ambient lighting order which is under development with one of the OEMs, but that's a category which largely is something which is not a core of this company, and we would perhaps cater to that from the other group company.
Okay. And just what is the industry mix in the passenger vehicle between LED and conventional lights? Industry mix and versus our mix? And how is this expected to grow?
Currently, if we see like our LED share is 60+%, and industry is running somewhere around close to 50%. So of course, as we mentioned, that LED is more hygiene today, and it is becoming more and more, and that's been reflected in our order book as well. So we see that industry will also expand, and our share of LED and electronics will also expand in coming days.
And there's some realization benefit in terms of LED and conventional? Or are both similar priced?
Yes. So basically, it differs model to model, but in general, because electronics has higher import content and content per vehicle in electronics based lighting is somewhere range from 2 to 5, 6x that way.
Okay, sir. So thank you, sir, for all the questions and congratulations for excellent set of numbers.
Thank you.
All the best.
Thank you. Thank you. You may press star and one to ask questions. The next question is from the line of Saurabh Jain from Sunidhi Securities. Please go ahead.
Hello. Yeah, congratulations, sir, for the wonderful set of numbers. We have, surpassed our initial guidance, which we had given at the beginning of the year by a wide margin. And sir, my first question connects to two things, capex and revenue. So, we are, getting into the fructifying stage of Chakan Phase 2, where the capex has already been done, major capex, and this would be the quarter where, commercial production would begin. And you had guided that in FY27, the expected revenue can be around 250 to 300 crore. Now, we had in the last quarter also, we had revised our capex guidance from 180 to 220 crore to 260 crore, and now we are again elevating that to 350 to 400 crore. Now, our Bangalore facility, where the major capex will be in FY27, and we were expecting revenue of almost 450 crore in FY28. So, how all these things are shaping up for FY27 and FY28 based on our current order book and the new capex? What kind of growth should one expect?
Yeah, thank you, sir. So basically, first on the Plant 3 Phase 2 part, you rightly mentioned that project is ready to go for SOP, and as per our previous guidelines, in this quarter, the month of March, most likely, March or April, sometime the SOP of the models will start, and ramp-up will take up in FY27 to 250 to 300 crore. As far as the Bangalore facility is there, it's a new facility which is under development at this stage, and the expected business start would be somewhere around quarter 4 of FY27. On the capex guidelines, as I mentioned, for the 2 years, that is current FY26 and FY27, we are maintaining our overall guidelines. Only thing is to like a preloading in the current financial year to speed up the execution as well as the customer timelines meeting requirement. But overall, the capex is same as we mentioned earlier.
So 350 to 400 for FY26, and next year would be?
Next year would be somewhere around 100 to 150.
Okay. So, sir, that brings me to the top line growth for FY27 and 28.
And in terms of top line growth for next financial year, we are looking at somewhere around close to 20+%. And overall, for next 3 to 5 years, we are maintaining our guidelines of 15 to 20%.
Okay. And sir, my next question is on EBITDA front. So last quarter we had an impact of forex fluctuations of 70 to 80 basis points. And this quarter you mentioned that there was some tooling profitability. So apart from tooling profitability, was there any impact of forex in this quarter?
No, actually this quarter, as such, there is no impact of the forex gain or loss.
Okay, and what would be the quantum of tooling profitability that was exceptional in this quarter, approximately?
So it should be about, give or take, 10 crores, which would be over and above what we usually do. If I look at an average, we do about 5 crores of profit on a quarter on a tooling. If you look at the last few quarters, this quarter has been exceptional because of certain key parts. So yeah, I would say 10 crores would be extraordinary gain from tooling in the quarter.
Got it, sir. That's helpful. My last question is on the localization front. Earlier, we had stated that we aim to increase localization to around 25 to 30%. I think we had already reached that level, and we were aiming for 50 to 60% mainly through PCB assemblies and certain electronics. So any update on that? And also, if you can just give the revenue numbers for SL Lumax for this quarter and 9 months, and how has been the growth during these 9 months, and what's the outlook for FY27? Two questions.
The localization is going well. I think overall, yes, we are upwards of 30 to 35% today. But again, it depends on the product category. For example, in something like connectors, we are at about 35 to 40% localization. But on a PCB, the bare board PCB, we've already achieved close to 70% localization. The SMT is 100% localized. And again, some LED modules and projectors are still high on the imported front. So it's a mixed bag. There are a few components which have a higher localization opportunity, and in the near term, some will take a longer term, and some will continue to be imported for now, like the LED modules. But overall, I think we're progressing well. Coming from a 10-15, we've reached a 30-35% overall localization level. On SL Lumax, I'll let Ravi answer that, please.
Yeah, so on SL Lumax in the Q3, as we see that they have reported a growth. Their Pune facility is now operational with effect from October 25. Therefore, they have reported somewhere around 15+% of revenue growth. On a 9-month basis, because the Q1 and Q2 were little lean, so they are close to flat, I would say, compared to last financial year 9 months. So in terms of revenue for 9 months,
Yeah, 9 months revenue was how much, sir?
Revenue for 9 months in the current financial year compared to last financial year is almost flat.
So what was the number?
Amount is overall number is 2,160 crore.
Okay, and how is the outlook for FY27 for SL Lumax?
Outlook for the current financial year. Most likely they will close somewhere around 27 to 2,800 crore. That's the outlook, but it all depends how the market will shape up.
Got it, sir. Thank you. That's all from my side. Wish you all the best.
Thank you.
Thank you. Thank you. Please press star and 1 to ask questions. The next question is from the line of Ronak Jain from Equirus Securities. Please go ahead.
Yeah, congratulations on good set of numbers, and thank you for giving me the opportunity. So my question is on LED penetration. So you mentioned that 60% of your revenues currently come from LED, but that is in terms of value. So I was looking on what is the LED penetration in terms of volumes in two-wheelers and PVs for the industry currently?
So it's a difficult thing to tell you exactly, because I would assume that the penetration of LED by volume would be close to about perhaps 70 to 80%. Please understand, by volume I'm saying, by value it drops, because again, when you look at the headlamp, which is a higher content per vehicle on a two-wheeler, that only has a part of the function which is an LED. The main lighting is still from a halogen bulb. So again, it's a partial LED lamp, not a full LED lamp, but when it comes to a tail lamp, we do see that there is a higher penetration of LED as a technology, and the full lamp itself is based on LED, along with the blinkers as well, which are more and more getting into the LED space. So again, by volume, I would say it would be pretty higher than value, but again, it's a mixed bag between a headlamp and a tail lamp.
Yeah, so just a follow-up on this. So you said by volume it would be higher, but in general, LEDs have higher content per vehicle, right? So shouldn't it be that by volume, LEDs would be lower penetration compared to value?
No, are you talking about two-wheelers specifically, or are you talking about the whole industry in pass cars as well?
Two-wheelers and pass cars separately. Like, you can tell us about both the things.
So again, from a volume perspective, I would say almost, again, there are a lot of smaller lamps which are not on a LED. As I said, when you say it's a LED lamp, for us, it's a partial LED. So again, the value content per vehicle is a mixed bag between how much LED value is going onto that lamp versus how much conventional technologies are still used on that lamp. We don't classify that as 100% value accruing towards LED if there are certain other halogen or certain other technologies in play. So again, from a volume perspective, yes, most of the lamps today have some part of function as a LED technology, and that's why when we report, we say that almost close to 80% of our order book is 81% is on LED lighting. But again, from a value-wise, it would tend to be lower because there is also a lot of lamps we make which are non-LED, which are more conventional technologies today.
Okay, got it, sir. Just one last question. So, can you specifically tell what would be the penetration for headlamps in LED in both two-wheelers and PV? LED penetration in headlamps?
Yeah, so basically, if we see overall our business has roughly around 70% is coming from front lighting. So front lighting is not only the headlamp, it's a combination of all type of lighting. And from our PV segment, today we are driving roughly around 55 to 60% from LED base. So by that logic, if we do, then that must be the LED contribution comes from the front lighting.
Okay, got it, sir. Thank you so much.
Thank you.
Thank you. A reminder to all the participants that you may please press star and 1 to ask questions at this time. The next question is from the line of Neeraj from Demac Capital. Please go ahead.
Yeah, hello. Thank you for the opportunity and congrats to the management team. We are finally at double-digit margins, which we have been aiming for so many years. So really commendable efforts, sir. My question was around our revenue split. So if you see, for the 9 months, Maruti is, let's say, 26% of our revenue, and also it forms a significant part of our order book. Just wanted to understand, out of this 26%, what percentage of revenue can be attributable to, which Maruti is in turn exporting, so can you elaborate on that?
Well, we are on a few models. We do not specifically track out of the total revenue of Maruti, what percentage of Maruti's revenue is coming out of export models. But we are present on various platforms which Maruti Suzuki does export out to the other countries. But again, for us, it is the same lamp which goes on the export or the domestic side. So it's very difficult for us to give you a very detailed breakup as to what kind of revenue comes out of the export vehicles.
Understood. And just on coming back to the margin commentary, I did hear your views that there were some one-offs as well on the tooling side. But will it be fair to assume that whatever margins, EBITDA margins we did in Q3, it is like the base, and from this we will build onwards because more and more capacities will come online, so there will be some operating leverage as well. Will that be a correct way to look at it?
Yes, absolutely. I think if you take out the extraordinary gain on the tooling, you would see that our margins have expanded based on the previous quarters, and I think this definitely should be a solid foundation for us to progressively now further enhance and expand the margins in the coming quarters. So I think we do see, we are quite optimistic on expanding our margins, not just in Q4, but going into FY27 as well, on again the back of operational efficiencies with the 15-20% growth, as well as better capacity utilizations.
Understood. Thank you so much, sir. All the best.
Thank you.
Thank you. Participants, you may please press star and 1 to ask questions. The next question is from the line of Nipun Khemka from CD Research. Please go ahead.
Yeah. Thank you for the opportunity. So my question is, how much development of new products integral to our future growth?
Sorry, could you repeat that question?
Yeah, sure. So, specifically regarding newer products, so how much development of new products integral to our future growth?
EV products?
No, sorry, new products. New.
So, if I understand correctly, you're asking me if part of the order book, how much is the EV business?
No. Let me repeat that question.
Mr. Khemka, I'm sorry to interrupt you. I would request you to kindly use your handset and try asking your question again.
Yeah, sure. So, yeah, now it's clear?
You may try, sir. You may proceed.
Yeah. So, how much development of new products integral to our future growth?
I'm sorry, I'm still unable to understand. You're saying two-wheeler products?
New products, sir. New products.
Yes, the new products.
Yeah. So, how much is that integral to our future growth?
Okay, so again, as I said, the order book is at about 1,760 crores. 60% of this order book comes into production in the next financial year, FY27. That is part of the reasons why we have accelerated and preponed the capex towards the Bangalore facility. As Ravi mentioned earlier, I think we do expect next year to give a revenue forecast of a growth of 20% plus, and I would say that close to perhaps half of that should come from the new product, and the rest would be organic growth of the industry.
Okay, got it. And my second question was regarding that is fast-paced launching of new models by OEMs considered good or bad for us?
A faster launch of models by OEMs fares very well for the company because pretty much in every facelift there is a styling change on both the front and the rear lighting. So for us, it is an opportunity, and it's a kind of a new product development. So yes, we've seen shorter product cycles now by the OEM. Earlier it used to be 3 to 4 years, 5 years in some cases. Now it's definitely squeezed to 2 to 3 years. So it definitely is a positive opportunity for the company.
Okay, got it. Thank you.
Thank you.
Thank you. To ask questions, you may please press star and 1 now. The next question is from the line of Ashutosh Tiwari from Equirus. Please go ahead. Mr. Tiwari, I have unmuted your line. Please proceed with your question, sir.
Yeah, am I audible?
Yes.
Yeah. Congrats on good set of numbers. Firstly, on the punch side, were you supplying earlier or is it a new order for us?
On the what side?
Tata Punch. Tata Punch is a new order for us or were supplying earlier also?
No, we were supplying to Tata Punch earlier also, and we have win the new orders also for the Punch, and it has a very short execution time, and we did it in very well.
So Punch,
Punch
has been an existing model.
Yeah.
Okay. And generally that now we are seeing like you talked about new designs and also has the content increased versus where we were earlier in Punch in terms of lighting content per vehicle in Punch versus earlier model?
Yes, in general, we do see the content per vehicle is increasing, but again, that is primarily because of different technologies and new styling requirements. I think we are progressing very well on the acceptance of new technologies, but again, this is probably more true for certain OEMs. So I'm not sure exactly what the new punch technology map is like. I would not be able to comment specifically on the punch, but in general, yes, we do see OEMs like Tata Motors, OEMs like Mahindra and Mahindra, with the new tech and the new innovation, the content per vehicle on the lighting is definitely going up.
And see, in LED as well, I think over the last few years globally as well as in India, there's a transition that probably first shifted to basic lights and now you're getting more advanced lighting and all. You must have seen that change. With that, even, like say, when you migrate to a new variant or new model, basically, are you seeing that there's upgrade in terms of technology and then that's why content will probably keep increasing? Is that thought process correct?
Absolutely. I think LED is just one piece of the puzzle. I think there are a lot of other technologies like, again, there are projector lamps, there are also adaptive driving assisting beams. All of those are very high technology. Again, it will not come to mass market. It will probably start at certain variants on the premium segment of passenger vehicles and then make its way into the mass market scalable models. Based on the price points, also will change accordingly. But yes, that is one of the reasons why the content per vehicle will continue to increase, not just based on LED penetration, which I think is fairly high already, but on the back of other technologies being introduced into the exterior lighting.
No, but on this point of LED penetration, like you mentioned that penetration is higher, but in that you include tail lamps and everything all put together, your blinkers, everything. But the high content is in the headlamp on the LED side, and now maybe in tail lamps also because you are now seeing across the length of the vehicle in the TVs. But in case of headlamps only, if I ask about what would be penetration of LED in two-wheelers and passenger vehicle, I'm talking about only in the two-wheelers and TV headlamps, the penetration, like halogen is what percentage and what percentage LED? Roughly, I know that you won't have the exact figure, but industry for industry.
So again, it's a very difficult question to answer, but I will try and give you some sense on this. On a two-wheeler lamp, again, as I said, there is usually a DRL or a separate front combination lamp that has a LED technology, and that is the only function which goes on the LED. Let us say the main light source for the main headlamp in two-wheelers is still on a halogen, which is the low beam and the high beam. So that continues to be halogen technology. So in terms of value, we don't have a breakup as to what is the contribution of LED as a technology on the total headlamp value and what would be the halogen, because for us it's the same lamp, and we look at the whole lamp as a unit. When it comes to passenger vehicles, this actually drops even further because the main source of lighting could be a halogen or it could be a projector lamp, which again has a very high value per vehicle. LED again could be just a turn indicator function, or more and more now we have seen there is something called a front center lamp, which runs across the front hood of a vehicle between the two headlamps. That is usually again on LED just because of the sleekness and just because of the styling requirements. So again, I do not have a clear answer in terms of what would be the LED content part of the headlamp on a two-wheeler or a four-wheeler, but if I were to give you a rough estimate, I would assume it would be probably a 40-60, 40% of the value of the lamp would be probably LED, or maybe 50% of it would be LED in passenger cars, and maybe another 50% would come from non-LED technologies. And on a two-wheeler, I would probably tend to say that it would be slightly higher at maybe a 60-40 or a 65-70-30 ratio.
And lastly, on just extension of this only, do you think that over next 3 to 4 year period, even this low-high beam on two-wheelers or even in passenger vehicle can shift towards LEDs?
It It definitely can, but I personally still feel that it's going to be pretty a long call as LED as a full LED headlamp to become mass market, because again, the cost and the economies just don't work out. As I mentioned earlier, most of the LED modules, not just for Lumax, but across the industry, are still imported. So they are not really been localized yet. But again, I would tend to say that instead of LED as a light source, more and more use of projector lamps and other technologies would come into play faster on the two-wheeler.
Okay, got it. Thank you so much.
Thank you.
Thank you. The next question is from the line of Aditya Bhoer from LFC Securities. Please go ahead.
Hello, am I audible?
Yes, Aditya, but there is a lot of background noise from your end. Can you move to a quieter place, please?
Yeah, am I audible now?
You may proceed now. Thank
you. Currently, first of all, congratulations on good set of numbers. And my management has been guiding that there will be a margin expansion. And currently, we are having a 70% volume penetration in LED lamps. So, is there any other contributor to this which will fuel margin growth? Yeah, that was my question.
Yeah, of course. I think margin growth is a combination of multiple factors. It is better asset realization, better capacity utilizations, optimized fixed costs based on a higher turnover growth, as well as, I say LED as a higher penetration will definitely aid a lot to the revenue side because of the contribution per vehicle, but it cannot be just seen as an automatic improvement in the margins. In some cases, the LED lamps may not be as profitable as some of the conventional lamps. So again, there are various reasons why the margins have expanded, and I think we continue to, as I said, remain bullish and optimistic that we will continue to progressively increase the margin performance of the company over the next quarters going into FY27 as well.
Okay. Thank you.
Thank you. Ladies and gentlemen, due to time constraints, this will be the last question for today, which is from Ajit Sethi from Eco Quantum Solutions. Please go ahead.
Thank you for the opportunity. Sir, as we have said that we are expecting half of the growth in FY27 should come from the new products. So should we expect that the EBITDA margin should be around 11 to 11.5% in FY27, and in the subsequent FY28 with our all capacity will come online? So can we expect to reach that 12% margin that you are saying that we will reach in 2 years?
So as I mentioned earlier, Ajit, I think the endeavor would be to attain a 12% EBITDA margin over the next 2 years or so. Having said that, yes, there are various factors which definitely, on the back of which we are confident that the EBITDA margin in FY27 should move forward and should become better than what we would deliver on FY27. But I think we are safely giving a guidance that the company has now achieved a double-digit EBITDA margin with a solid foundation, and I think we will continue to expand on that. So I don't know specifically if we will hit 11% or so in FY27, but yes, we will continue to expand the EBITDA margin, from year after.
Okay. Thank you, sir.
Thank you.
Thank you. As that was the last question for today, I would now like to hand the conference over to the management for closing comments. Thank you, and over to you, sir.
Well, I would like to thank you all for joining us today. We hope we have addressed all your questions. We remain committed to keeping the investment community informed with regular updates on any developments in the company. For any further information or queries, please feel free to reach out to us or SGA, our investor relations advisor. Thank you.
Thank you, members of the management. On behalf of Lumax Industries Limited, that concludes this conference. We thank you for joining us, and you may now disconnect your lines.